my career has been a leading indicator of crisis. I joined at Deutsche in January of '98, and in August we had the Russian currency crisis, which led to all sorts of turmoil. And when I left Morgan Stanley, where I ran their global emerging markets group in June of 2008, to go to the buy side and take over the emerging markets business at GLG Partners. I arrived at GLG Partners exactly on the day that Lehman defaulted.
Hello, this is Abhilash Jakamar, co-founder and managing director of Trust Vista. Today on Trust Vista Talk, I have the pleasure of being accompanied by Bart Turtelboom. Bart wears many hats. He's a senior fellow at the School of Advanced International Studies at the Johns Hopkins University. He's a co-founder and CEO of APQ Global Limited, and he's also the chairman of the board at Delphos International. Bart, thank you so much for joining us.
It's a great pleasure, Abhilash. Thank you for having me.
So maybe to start, I said you wear many hats. What are these hats and how are they interrelated?
So I've been in emerging markets banking and fund management for the past 25 years at various institutions. And in 2016, we listed the company APQ Global on the London Stock Exchange, which last year acquired Delphos International in Washington, D.C. Delphos is a super interesting company. It's a financial advisory firm that has over the past 33 years raised $20 billion for over 1,000 clients in emerging markets from development finance institutions. It's at the forefront of the advisory work in this space, and it's been a cracking success story.
Fantastic. You talk about Delphos being involved in emerging markets for over 33 years. You yourself personally have been involved in emerging markets for nearly the same amount of time. At the IMF in the 90s, dealing with emerging markets. Maybe can you share a little bit about your background with emerging markets?
Yes, I would love to tell you that there was a grand plan of ending up in emerging markets finance, but
no, you can pretend it's your story. You can say you predicted globalization, you knew that the internet was coming.
The truth is much more prosaic. I grew up in Belgium, studied at Columbia University in New York, where I did my PhD, and then as an aside here, one way to postpone my military service in Belgium, I decided to go and work at the IMF, which was part of the UN umbrella, and under the UN Charter, whoever works for the United Nations cannot be called up for military service, which I then later on had to deal with. And there at the IMF, I started there in '94 and did a fair amount of work on the Asian currency crisis. And that's how I got involved in emerging markets finance. Then in '98, I left with 12 people, which was a highly unusual move to Deutsche Bank, where I ended up in emerging markets research. And from there it went. I should also add that my career has been a leading indicator of crisis. I joined at Deutsche in January of '98, and in August we had the Russian currency crisis, which led to all sorts of turmoil. And when I left Morgan Stanley, where I ran their global emerging markets group in June of 2008, to go to the buy side and take over the emerging markets business at GLG Partners. I arrived at GLG Partners exactly on the day that Lehman defaulted. So it's been an up and down ride in emerging markets, but obviously something that in this asset class we're fairly familiar with.
Yeah, the definition of crisis evolves as you go through more and more of them. But you mentioned you studied at Columbia. You actually have a PhD in economics, and obviously that's very valuable when thinking about emerging markets. But from your experience, how is an economist, different in their approach to finance than a traditional investment banker, or someone who's more of a financier than an economist? How has that helped or hindered your ability to be successful?
I think it's tremendously helped in in emerging markets, particularly from two perspectives. The first one is by spending the time on the master's and the PhD, it gives you at a rather critical time of your life an opportunity to really think through some fairly significant matters in the field. And having taken that time is certainly something I don't regret at all. More importantly, specifically for financial markets, when you look and compare emerging markets and emerging markets investing to G7 markets, what you find is that in G7 markets, in between sector dynamics, company-specific dynamics, and macro dynamics, the sector and the company-specific dynamics dominates. In emerging markets, it's the exact opposite. The macro truly dominates. And the reason for that is fairly obvious. You may be the absolute best picker of wonderful growth companies in Nigeria in your private equity fund, but when your fund life is up and you have to sell in the midst of a currency crisis and convertibility issues, you could have picked the best company. It's not going to matter. You're going to be stuck. And from that perspective, taking a macro perspective to emerging markets and emerging market investing, I do believe is incredibly helpful.
Yeah, I had many friends, who run funds out of India, and a lot of them have their investment committee sitting overseas. And a lot of them find it very frustrating to explain to those investment committees every time on the country-specific risk, right? And so it's been a challenge for a lot of international investors, large PE shops who say we want exposure to these markets, and they set up a shop, but they don't have the DNA for it. And similarly, the type of people willing to commit capital, the LPs, the family officers, the HNIs, having that understanding of that risk really matters. Otherwise, they get spooked by it. Obviously, it gets exciting when you talk about the country risk premiums that get attached, especially in times when you think things are great and things will never go bad and yields are really low. People fly to emerging markets. But in your acquisition of Delphos, what does it really take to raise capital and educate investors who would otherwise not understand the risk but like the return profiles?
It's a challenge. And it is a challenge because emerging markets is a very sentiment-driven asset class. It's always completely black and white. It's totally the future, and the West is totally messed up, or it's the exact opposite. It's all about Silicon Valley and US tech, right? And as an old friend of mine in the asset class always reminds me, he says, look, you can never convince an investor to invest in emerging markets when yields are over 15%, and you can never prevent them from investing when yields are below 5%. And I'll give you an example of that. 2008 was perceived to be an episode where there was a collapse, which is quite accurate, in the US and European financial system due to the fact of probably some regulatory failures, over leverage in very specific products. And that after the crisis, and then obviously Lehman defaulted, which is a US investment bank. And obviously the narrative that developed afterwards was, this is further proof that the future lies in emerging markets, and all we need to do is go to Colombia and India and Indonesia and invest there. And I know very large endowments and pension plans that made a significant reallocation out of G7 and US equities into emerging markets. What happened to unfold was the exact opposite. The S&P outperformed everything else, the US rebounded very quickly, and emerging markets went through a fairly challenged period, which, to be honest, with various bouts, it does remain a challenging environment. So yes, you're absolutely right. The challenge to convince investors to invest in emerging markets is very much there, despite the fact that it is certainly right now one of the very few asset classes where I do believe there is a significant risk premium that can still be extracted, and that rewards you well for the risk you're taking.
So what are some of the solutions for emerging markets, you think, for the future to attain that stability?
They have made huge progress in developing their domestic capital markets. So obviously, to the extent that you can rely on longer dated funding in your own currency, and you can sell those instruments, be they equity or be they debt, to Western investors. Obviously, that gives you a cushion by limiting the currency mismatch that you often have in the corporate sector in those countries. And I think quite a few countries obviously have made huge strides in that on that front. And I think that's been an area where they have made enormous progress. The second area where COVID notwithstanding, significant progress has been made is there is just a much higher level. And there are obviously exceptions, but there is on the whole much higher level of macroeconomic stability in emerging markets. You look at India, you look at China, you look at Central Europe, you look at Mexico. Yes, they are going through tough times because of COVID. Yes, global trade is challenged. Yes, global supply chains are challenged. But on the whole, nobody is sitting here saying Poland is going to default, or South Africa is going to default, or Turkey is going to default. Are they challenged? They're definitely challenged. And they're largely challenged also, let's not forget it, by the completely unfair and unequal rollout of vaccines. So let's not forget that little thing either. But on the whole, they're weathering the storm quite well. And I suspect that really bodes very well for the next 10 years in the asset class.
Shifting gears a little bit, I want to talk about impact investing. You know, there's been a lot of conversations about the next generation of wealth managers, right, and the wealthy individuals, right, the inheritance going to the next generation who seems to be more socially minded. And so, you know, there's been talk about ESG in investments and how do you measure that, and impact investing is a category with that, and that can mean a lot of things. Now, in emerging markets, I've seen a lot of funds attach impact investing to what they do, sometimes post facto, you know, say, well, we created jobs in an emerging market, that's impact, right, which it is. But when you think about impact investing in emerging markets, what does that really mean to you?
It's a super interesting question, Abby, because there are as many definitions as impact investing as there are impact investors, right? So clearly,
and to be transparent, I should tell you, I'm actually on the board of a impact investment fund that invests in East Africa and India at a seed stage, right? So, but we are structured as a charity, so it makes it a lot easier to really be true to the mission of impact.
Yeah, you have the interaction. First, you have the interaction of the non-profit sector and the profit sector in the space, which on the one hand, I think is quite healthy, but on the other hand, also creates its own incentive problems. So it's a bit of a challenge environment. The truth of the matter is, as you quite rightly say, it's very easy to say that you're an impact investor. It's a whole lot harder to define what that exactly means. And last and most certainly, I am not going to say that I have the holy grail to that answer. Now, obviously, there are some basic tenets underlying impact investing, the United Nations SDG goals, all these type of things. And there's also a cottage industry developing to really refine and come up with more standardized impact metrics. But I do think one of the big challenges of this approach to investing is exactly what you just said, the nebulous nature of what it really entails. And it will take, for the wave of impact investing, it's a very powerful wave, and I think is absolutely here to stay. And I think it's going to become a very dominant factor in the way investors are going to deploy capital. Having said all that, when you're on a pension plan, you have to pay your pensioners their pension with US dollars, not with SDGs. That is not how this thing works. So at some point, the rubber is going to meet the road. And what we are focused on our side, on the Delfo side, what we are really focused on is where are the best impact opportunities? Where are they? What it is? And again, it's not a very easy question to answer, but it's most certainly something where we spend a lot of our time.
So what are your plans related to impact?
When we look at the impact investment space, we see a fantastic opportunity. And the best way to describe it is that if the fund where you're sitting on the board if somebody were to come to them and say, listen, I want to start a chain of pharmacies focused on women's health in Ghana. The entrepreneur locally in Ghana is going to have no issue finding the equity from private equity firms focused on Africa and emerging markets. He or she is not going to have any difficulty getting senior debt from development finance institutions as long as the business plan hangs together very well. But God forbid that she would need long-dated local currency financing to meet long-dated local currency liability. So there is the missing link in the middle. And that missing link has many aspects to it. It goes from a very simple senior to equity, but junior to debt mezzanine type financing, to political risk insurance, to the missing bit of what tends to come from export guarantee agencies. So there's that area in the middle that is really offering a fantastic opportunity. And first, it would filling that gap would unlock a lot of projects that are currently stuck. That's one. That's the most important thing. We are currently working on a project on bioethanol in Mexico, and that is really the missing link. The equity is there, the senior debt is there, but the hybrid instrument in the middle, which is actually quite lucrative, is very difficult to fill. Why is it difficult to fill? It doesn't fit in the mandate of private equity funds. It doesn't fit in the mandate of senior debt funds, AA or AAA World Bank stuff. And Western banks, which used to take a lot of that stuff on their balance sheet, are now actually withdrawing from the space for two reasons. One is they're making too much money in the US on SPACs to bother with Ghana. That's one issue. And the second issue is they always run the reputational risk of lending to the long guy and KYC and all those sorts of things. They say, you know what, let's forget about all these things. So the way we are planning at Delphos to fill that gap is to be quite ambitious. And the ambition we are having is to start a global impact bank. We plan to do that over the next couple of quarters. It's not a fund. It's not a fixed life instrument. It's going to be a proper lending institution. We're going to start with a capital vehicle and then get a banking license afterwards. And the reason we want to structure it that way is because, coming back to the conversation we had earlier, first, it's going to prevent us from falling into the trap that 6 years from now we have wonderful exposure, but our fund life is up and we need to sell everything. So we're not going to fall into that trap. Secondly, the single biggest challenge that I see in the emerging markets impact space is that most players are subscale. There are so many 35 million Bangladesh water funds and Ecuadorian forestry funds and Kenyan agricultural funds. And they all have 25 million, 30 million, 50 million. This way we're setting it up allows us to go for scale. And this whole impact investing effort will fail if we cannot come up with big, scalable opportunities. And that is our ambition. It's ambitious, but I think we will get there. And we have put together an absolutely fantastic team to execute it.
Think big or go home. I like it. Speaking about thinking big in the emerging markets, a lot of the largest pensions and endowments in the world, who control a lot of the capital, they can't make small investments. So if they're going to commit to something, they want to put in 50, 100, couple $100 million. But at the same time, they don't want to be more than 10% of any capital pool. So it was very difficult for emerging managers to even attract that type of capital. There was one player who was trying to do it, Abraj, which is known in emerging markets for the wrong reasons now. But when Abraj folded, that did take a hit for emerging market fundraising for a lot of folks, because a lot of people got burned and they just wanted to stay away from it. How has that specific incident impacted fundraising, and how has it evolved since then? It's been a couple of years now.
These type of episodes really put proper dents into the credibility of a lot of what's going on in emerging markets. But having said all that, I'm going to come here to the defense of the investment managers and the investors and the pension plans and the endowments in this asset class. Last week, we had a disaster with the deleveraging and the margin calls on blue chip US stocks, right? So we had the Greensill saga on trade finance in the UK and in Europe and in the US, right? So he who is without sins cast the first stone. And I want to
never had a financial crisis.
I'm sorry.
I said the U.S. has never had a financial crisis.
Exactly. So you know, Abraj was a terribly unfortunate episode, and it was a terribly important episode because it was a glaring, very basic thing that post 2008 the market and the regulator were supposed to have taken care of. But nevertheless, within the context of an asset class which was post 2008 trying to find its feet again, and with the very heavy financial backing from development finance institutions, I'm not going to deny it was it was a meaningful event that made a lot of people think twice about getting involved again. But then again, in finance, there is very little memory. You know, give it a couple of years and people.
Earlier on in this conversation, you had mentioned when looking at emerging markets, a lot more weight is given to the macro rather than the sector or the specific company. But you are in the business of investing in specific companies. And certainly corporate governance is a material part of that business-specific diligence apart from just the business plan and the industry. How do you see corporate governance standards changing in emerging markets?
They're improving. And they're improving substantially. And they're improving substantially for the extremely simple reason that they have to. And they have to because to the extent that it's basic macroeconomics 101. If you have two parts of the world, both 50%, give or take, and one grows at 2%, and the other one grows at, and the other one has a GDP which is half of the other per capita, and one grows at 2%, and the other needs to grow at 5% to catch up. Well, I have news for you. The ones that grow fast need to attract capital from the other ones. And to do that, these standards are improving. And on that front, whether it's the whole ESG, sustainability, impact investing framework is putting very significant pressure on a lot of banks and corporates in emerging markets, not just in emerging markets, but particularly also in emerging markets, on their regulatory framework and on the way their companies are run. And we see that. And it is something that a lot of Western investors continue to forget. We are in active discussions with a couple of companies in Azerbaijan. They have impeccable management, highly sophisticated management, super smart, incredible. At the best standards of what you see in Western companies.
As you know, it gets more competitive and people realize that corporate governance is a differentiator, then market dynamics drive people to have better governance. I agree. You mentioned SPACs. I don't want to get too much into why what's happening is happening, but specifically, you know, in emerging markets, do you think that is a vehicle that will make sense for emerging markets, or the dynamics of regulatory environments and capital just different enough that it's not going to be meaningful?
I think, look, I think emerging markets are well suited for business combinations on the back of SPAC issuance because they combine a fair amount of gearing in certain and fast growth, which is really what you need to have these business combinations make sense for SPAC sponsors. I think I've followed the space for the past 3-4 years, never gotten involved in it. But there is room for those type of things. But you also know you're in a bit of bubble territory when on a Sunday morning I receive 5 phone calls that I should go and do a SPAC, and that on top of it I get 2 more phone calls from large financial institutions who will remain unnamed that they will fund me and lend me the money to pay the SPAC sponsor fees.
Certainly interesting dynamic that's happened on, you know, one of our very first clients 15 years ago was a SPAC looking to acquire an Indian manufacturing business. But now it's just becoming a shortcut to an IPO, right? And in the US, it can be a very long process. So a lot of it is driven by the regulatory environment. And when you think about emerging markets, well, every country has its own regulatory framework. So when you think about the opportunities for SPACs, it really kind of depends, I think, on which market you're speaking about. And even access to investments in the US, a retail investor may not get access to an IPO, right, unless they're a meaningful client to the underwriter. Whereas in a market like India, the book building process is one where everyone gets allocated shares pro rata based on their order, so everyone can be guaranteed an allocation.
Yeah, look, it's a very valid point you're making, but also I would say that the SPAC phenomenon has been largely driven, to a large extent driven, by a zero interest rate environment, right? If you look at the people who've been buying into SPACs, where all the money goes into an escrow account, they have to give their permission on the business combination at the back end. What do you see? A lot of money market funds are involved in it. It gives them a bit of equity upside in case they like the deal, and if not, they get paid spread over LIBOR, which is what their line of business is. So, put 10-year treasuries back at 4% and Fed funds at 2%, and the picture is going to be a whole lot different.
Maybe just some closing thoughts from you, Bart. Again, going back to, you've had a very long history in emerging markets, over spending decades now. Where do you see the world 10 years, 20 years from now?
I look at the world 10, 20 years from now where there is no question in my mind that the world will become much more multipolar. In other words, whether it's the rise of China, the rise of India, and the rise of Nigeria, for that matter, right? I mean, these are very large countries, is going to continue. So, and in a sense, from a sort of humanistic perspective, alleviating poverty, taking women out of poverty, these type of things are very lofty goals. And if those lead to certain countries gaining in political power, that is a good thing, not a bad thing. I mean, it should not be the prerogative of people in Belgium to have access to clean water, and everybody else should sit at home and deal with it. That's not a reasonable way of looking at the world. So I think the world will become more multipolar. I think Western countries, the US and Europe, will become more internally divided on the back of increases in wealth and income inequality, and that I think is going to put their political systems under significant pressure. May this be the last pandemic in our lives, but we could have a couple more. And hence, I'm predicting a world where emerging markets will do well, but within the context of an overall world economic and political order that is going to become more volatile overall. So, it's a bit of a positive story within the context of increased volatility.
Yeah, and just from your own business building perspective, obviously, you, in this acquisition of Delphos, you have great ambitions to grow and scale the business even more so than you have in the last 5 years. What are some of your strategies for business building in a global environment?
You know who does the best in France? The French. And you know why? Because they've been there the longest. So globalization is here to stay. The probability that 5 years from now all Christmas lights in Switzerland will be produced in Switzerland is close to zero. They will continue to come from China, and if they don't come from China, they will come from Turkey or Nigeria. So these trends are clearly there. However, adapting our growth strategy, which is certainly something we are already doing, have done for a long period of time, and will continue to be a focus to, I hate to use the phrase because it's been misused so often, but a sort of feet on the ground, genuine local presence is, I think, going to be incredibly important for a global business. In other words, I predict global businesses will need to become more decentralized and exhibit more of network characteristics than centralized bureaucracies that you often see right now.
Yeah. Well, I think this call is a great example of globalization. You're in Switzerland, I'm in New York. Your trust assistant team sits in, who knows how many cities in India as they work from home. So, and we're still working. And so we've been privileged to work with you these past several years, and we'll look forward to continue growing with you and being part of that story. Bart, thank you again so much for spending the time today.
You're very welcome, Abby. It's been a real pleasure. Thank you so much for inviting me.